This week, however, the report stood out for us. It posed a key question: which miners are most exposed to fluctuations in the gold price, both up and down? Put simply, the focus is on which mining stocks are the most and least leveraged to gold price movements.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning. I'm Vince Lanci, and this is the Gold Fix Market Rundown. We'll be discussing Bank of America's latest gold miners report, revealing a massive shift. You could see the gold mining screen that I have there, but we'll come back to that in a minute. 10-year yields are 431. The dollar is 103.51. The S&P 500 is 56.61. Gold is 30.29. Silver is 34.14. Copper is 496. Gold is up $28. 30.29. $3,029. WTI is 68.69. Natural gas is 404. Bitcoin is 82.68. Palladium is 972. Up 4. Platinum is 1007. Up 5. Platinum might be hitting 1100 before UBS's report is even out more than a month. Soybeans, 1007, corn, 448, and wheat, 576. Okay, so let's get to the main event. One last bit of business before we start that. Yesterday's Gold Fix analysis, closing the gold lease loophole. That was the morning rundown. Goldman, here's why gold rallied last week, and it's correct. Founders AM Bank asks which miners are most exposed to gold. That was a preview for them. They saw the report we're going to discuss right now, and that report will be out to premium later on today. Rabo, let them eat flat screens, and Gold Fix PM, which has a cartoon of the dollar on it. There's the front page, and off we go. Discussion. Gold price leverage, who's exposed most to up and downside to gold price changes? All right. This is a Bank of America report. The latest report, weekly report from Bank of America, exposes a shift in focus. This report covers senior, mid-tier, intermediate, and junior producers, as well as royalty companies and the remaining primary silver producers in the market. Typically, Bank of America's metals reports are a routine publication, data-heavy, filled with colorful charts, comparing miners' performances to the stock market, and are largely uneventful. This week, however, the report stood out for us. It posed a key question: which miners are most exposed to fluctuations in the gold price, both up and down? Put simply, the focus is on which mining stocks are the most and least leveraged to gold price movements. The report spends a considerable amount of time outlining the key drivers of gold before diving into multiple data tables used in valuing miners. It's worth noting that this report is almost directly a response to client demand. Given Bank of America's recent gold trading primer, which we talked about here about 3 weeks ago, from a few weeks ago, it's clear that the grassroots interest in precious metals that emerged post-COVID is now expanded into the mining sector. The shift isn't happening in a vacuum. Gold and silver prices have surged, but there's another factor at play here. The so-called darlings of the market, tech stocks, AI stocks, speculative unicorns, have lost their shine. We're including a chart illustrating the massive disparity between tech stocks and mining stocks over the past 4 years to highlight this trend. There's that chart. The top chart is the SPX versus gold, and the bottom chart is the SPX gold versus SPX versus GDX. All right, the top chart is courtesy or derived from something that Goldman Sachs had said, and the bottom chart is something that we put together because it really kind of interested us. All right, the contrast between mining and tech, let's get into that a little bit. We're talking about the premise or the pretense or the lead into why this report is important. While technology promises future progress, these are just projections, unrealized and speculative, but they sell. Tech stocks thrive on marketing, hype, and sizzle. You see it daily in the press, right? Mining, by contrast, is an industry that delivers exactly what it promises, but that makes it boring from a marketing standpoint. The lack of a story makes it harder for Wall Street to push mining stocks onto investors. Push, promote, influence. That's why this report is significant. It follows previous Bank of America analysis by Michael Hartnett and builds on their gold primer, signaling a potential shift in investor sentiment. Michael Hartnett never talked about miners. He said, sell American tech stocks, buy overseas stocks. He said, sell stocks, buy bonds. He said, sell stocks, buy gold. He never said sell stocks naked. When you put all those things together, he should have said sell stocks and buy miners. Now, was that an error on his part? No, that's just not something that he focuses on for his clients. However, if you're buying emerging markets and you're buying gold and you're selling tech, you're buying miners. And that's what's going on. So it is unlikely that banks are, in general, are actively pushing to put miners in their clients' portfolios. Their preference, buy the dip in tech. AI is the future. Stay the course, yada, yada, yada. But clients, I think, are pushing back, saying things like, don't you remember inflation last year? Don't you remember the banking crisis in 23? Now you're telling me to buy more tech while it's tanking? Gold is at 3,000. You never told me to buy any. You just hear that all over the street right now. I think I'll put some money into mining stocks instead, right? And so they're responding to that. These are the conversations happening behind the scenes, conversations banks hear, but you don't. During my own time as a trader, salespeople frequently called me from other desks asking, what should we do? I've seen firsthand how banks react, not because they want to, but because their clients force them to. And right now, clients are forcing them to acknowledge gold's performance. And that will manifest either in more money into ETFs and more money into mining stocks. So what's in the report itself? Bank of America's weekly metals report now includes a primer on why gold has rallied and a detailed breakdown on which stocks are most correlated with gold price. And the key takeaway is which stocks have the highest and lowest operational leverage to gold price changes. Because their clients are saying, I want to buy gold. Some of them are saying gold's too high. I want to buy something that's like gold, that tracks gold. And they go, all right, well, let's give you the miners that track gold the best. So which banks have the highest and lowest operational correlation with gold price? We believe the report signals the beginning of a shift in bank positioning, not necessarily marketing, positioning. They're going to market them, but after they position them, in my opinion. Clients are looking for gold exposure, but don't necessarily want to buy ETFs, right? Might be a little bit too high. They might be a little bit more price sensitive. They want something clever. They want to buy the dip in gold, and no one will buy the dip in gold, at least not at the ETF level. They will buy the dip in miners, though, because you're buying companies. So they're looking at miners now, we think. Where is the market headed? Well, we don't know, but we believe this is where the next big move happens, right? Miners have performed well recently, but have been wildly uncorrelated to gold over the last 18 months. That correlation is shifting. The full report will be broken down and made available to subscribers, premium subscribers, around noon today. In the meantime, here's the key takeaway of the report. The gold commentary is excellent. It's not anything you don't know if you're a gold fix person, right? It's a solid summary for anyone following the market. It's something you give to your family when they say, tell me why gold is up. Boom. And you're like, I don't want to get into the 15,000 words that Vince has written because it's really quite long and I've already digested that. Just read this and get back to me. If you're a GoldFix Premium subscriber, as I said, you already know that. If you're a tech investor considering gold, because that's who this is written for, this gives you the rationale to make the move, whether it's into ETFs or miners. Now, final thoughts. If you're skeptical of banks, and let's be honest, given our asset class, who isn't? They are the influencers of a previous era. That said, they know how to respond to customer demand. And so if you think of what happened to gold and silver after COVID, they're finally responding potentially. We're at the beginning of a response to customer demand. You might see more stocks be listed. You might see recommendations come out. You might see individual equities, but they want to keep the money in-house. So if it's out of tech, they don't want it to go into a money market. There's no fees in that. So if you think that's a reason to not buy miners, fine, but I'm a flow trader and I see where the flows are going and I hopefully skate towards the right flows. So outside of Michael and a few select high-level analysts, no major Wall Street bank is yet telling you to sell tech and buy miners. And as a disclaimer, we're not telling you to do anything. We're just telling you what we're doing and what we have done. So the chart's there. Top chart, SPX versus Gold Cross, now back through two. There's plenty of better charts out there or more detailed charts, but we're showing you what was conveyed from a Goldman Sachs trader that he noticed about gold. All right, so the gold chart, the left oval is during the crash. Stocks crashed through. That green line is 2. The market went below 2, and gold stayed below there for a pronounced amount of time, and then worked its way back up, and then it dipped again below where gold outperformed stocks during the COVID era. Remove COVID, okay? Pretend it didn't happen. I mean, we can't, but you get my point. Why did gold outperform stocks in the SPX back then? October 07 is when it crossed last time. Well, it outperformed because we had a crash, right? Okay, so you may say, first level, oh, we're going to have a crash. Maybe. I don't think so, right? I think if we're looking at it, the Fed's looking at it, and they're probably not going to let it crash. They'll probably let it drop, but they're going to let the bubble deflate, but not a crash. So again, ignoring COVID, here we are over here. Why are we doing what we're doing? Why are we through it again? Well, investors are aware of it again. You know, we had inflation. We had a banking crisis. You know, I think I'll put some of my money in something safe. What's the Philip Morris for this generation? Well, it's going to be miners, which is the 70s all over. So after seeing that chart, I said, let's see what it looks like for GDX. So I went, this is the bottom chart is SPX divided by GDX. And so during the great financial crisis, there's the dotted line, the oval's a little bit to the right. Miners peaked at this level here. I can't even see the level right there because I hit it with my own logo. But it didn't even get to that level during COVID, even though miners did better. You know, well, miners did better, but it was juniors doing better. Dave Kranzler reminded me of that. This time, look at the spread between the SPX and miners. So even if miners don't go anywhere, the SPX is going to go down. Now that's not comforting to you if you're long miners. I, however, am long miners and from time to time short tech. So I will play that arbitrage. Anyway, this is what we've included, right? There's the cover. There's the valuation overview. There are plenty more charts there. I'll show you what else they have. Okay, they have net asset value, reserves and resources, price to net asset value for North American gold and precious metals producers and royalty companies. Plenty of grids and charts, but it's constructive. It's not like, look, RBC had a report out last week, and it was good, great charts, but it showed me nothing but money coming out of stocks, right? So they have 2025 production guidance, 2025 cash cost guidance, 2025 all-in sustaining costs, that's an important one, right? 2025 CapEx, valuation comps, North American gold producer and royalty streamer, price to net asset value history, and much, much more. For now, we've included some price to net asset value and EV to EBITDA at the bottom. Market recap. Stocks ended higher in choppy trading as investors weighed latest economic data and U.S. trade policy. Shorter dated treasury yields rose on improved retail sales. The dollar weakened while gold prices continued to surge. Oil prices ticked up on U.S. attack on the Houthis, encouraging news out of China. There's some market news. We have full stories for those in premium at the bottom. You have your whole Wall Street Journal without the bullshit at the bottom today. All right. Data on deck. Fed decision was on Wednesday, and you can see we have a little bit more of the we have a little bit more of the data for. We have the best performing in their group, price to net asset value and price to EBITDA or enterprise value to EBITDA. Okay, final check on the markets. We're just going to give you a cursory look here. This is GDX. GDX is called 4538. I think that's up 2%. No, up about 1.5%. There's silver. There's the silver miners. The fact that there's a call higher means that people are trading them at night now, right? There's the GDX versus AIQ. That's my GDX versus tech stock trade. And on the lower right-hand side is silver, which is 34.21. And 2 days ago, I said it's likely to hit 35. Well, it's likely to hit 35. Final comment. I called a guy that I work with on metals, on physical. I was like, let me buy some physical. And every time I go to buy physical, the market rallies, and or it takes him a day or two to get back to me. So I'm going to buy miners instead of physical. Give you an idea. Okay, so I'm not going to wait. Timing is important right now for me. So I'm now looking at, do I buy a silver brick? Do I buy some gold? Do I buy some maples because I think they're going to go up in price? Or do I buy miners? I'm probably going to buy a combination of the three, but you can't buy physical just by pressing a button. That's it. I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lancy. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.